Uh, I can't see what's on the screen.
As in it's too small or my screen stopped sharing?
No, my screen has, for some reason, it has me in safe driving mode.
And you can no longer.
I can't see it. Yeah, I don't know what's going on.
Let's try to reshare. Maybe that'll refresh it a bit. Does that work?
No. It doesn't matter. I have the paper in front of me. So the first slide with the little charts or the little pie charts, in general, there hasn't been any major significant changes in any of this data. The population has been relatively consistent throughout the last 2 years. The majority of your people are enrolled in family plans, and the majority of your people are enrolled in the high deductible health plan. There's still a few people sitting in a Century Preferred plan and a few people in the HRA. Those are the folks that did not qualify for an HSA for some reason. To get into the real specifics, let's skip to Tori, if you can go to the town cost report.
Okay.
Year over year, last year, the town ran a loss ratio of 67.5%. So last year during COVID, primarily, claims were extremely low. There were hardly any claims at all. This year, we started off the year pretty solid. July, August, and September were all below 65% or less. But then October of 21 hit and the numbers started to go up. So we looked at what was driving that number. And while it wasn't across the board utilization, you did have 5 large claims that were on the town side. Those 5 people at the end of the year, on a gross basis, those 5 claimants generated $935,000 in claims. To put that into perspective, your total gross claims were 3.7 million, including dental. So 5 people generated a very significant percentage of that 3.7 million. Of that 3.7 million, we had stop loss reimbursements of $211,774. So 3 of those claimants did exceed the 175 stop loss. So those were not charged in the experience. And ultimately, those 5 people generated $723,473 towards the claims that you ended up paying this year. That's what's driving it. There were 5 people that were not in previous data, and they were all at least 100 or just under 100,000 to as much as $277,000 in claims. Of those claimants, there is that a board person? I think it's a board person. There's one individual that Blue Cross has identified as a potential ongoing large claim. There's a person that's being treated for rheumatoid arthritis, and they're taking an expensive medication. Last year, we spent $143,401 on that drug. That could be significant next year. We're keeping an eye on it. So that's what was driving claim costs. Sorry, if you go to that last page.
Comparison page, or do you want to look at the?
I want to skip let's skip to the frequency distribution.
All right, sounds good.
For the town, what this chart did is we looked at the claims that, how many claims did you have that exceeded 50,000, how many exceeded 75, and so on, to get an idea of what how those large claims impacted and what the year-over-year change was. On the right-hand side is the town. In the prior year, last year, there were 8 claimants that exceeded $50,000. This year, you have 11. There were 3 claimants that exceeded 75. There were 5 this year. Then we get into the rest, which was claimants that exceeded 100,000, 125, 150. No one exceeded 175 last year. This year, there were 3 that exceeded 175 and 2 that exceeded 200. So that's really the picture here, is that there were more claimants over 50,000, and the ones that we did have were higher, and they didn't necessarily get over the 175, but they did get closer to the stop loss. It's not unusual. It happens in cycles, and what's unusual is how low your claims were prior, but the year over year, that's what we're seeing on the town. The board was pretty consistent. It did go up, but it didn't have the board's bigger, so the claimants didn't have as big of an impact on the numbers, and we were pretty consistent and came in under budget on the board. That's what I have there. Do you guys have any questions?
Yeah, any questions?
Hey, Dave, just on that frequency chart, do you have expected cost? And they're the same for the board and the town?
It's the combined number.
Oh, that's the combined number down there? Okay.
Yeah. We didn't have the ability to split it when we did this.
Yeah.
I want to, but that's just the combined total. So if you add them together,
Right.
that honestly, that number is the expected instance rate is an actuarial figure, and I don't really put a whole lot of stock into it for the size of group that you are.
Right.
It was really wanted to show the other 2 columns just to show year over year change.
Yeah. Okay.
I just had one question.
Yep.
Is it relevant at all, the impact on the town, whether the person is in an HSA or a point of service plan, or is that irrelevant because of the large numbers we're talking?
It's irrelevant.
That's what I thought. Okay, thanks.
Any other questions?
I guess the only other question I had is there's some other claims there and on the large loss list. And all of those are pretty much done other than the rheumatoid arthritis, because I see some, with persistent mood affect disorders.
We don't expect them all to be as significant as they were.
Okay.
The only one that Blue Cross flagged was the rheumatoid arthritis drug.
Yeah.
And that's because that could be $1 million.
And that's because the cost of the drug, right?
Yeah, that one was very concerning. The other ones, the cancers are usually one-offs. So you usually don't see ongoing over 175 after that.
Yeah.
The colitis one could be another big one, but we're not expecting that they're going to be significantly over. I'm a little concerned. I mean, it's going to be an interesting stop loss renewal next year.
Yep. Okay.
So I don't want to scare you now, but there's going to be, we will be doing some severe negotiation and marketing of the stop loss.
Okay. Can you tell me what I counter for other aftercare? Does that just mean somebody came back for additional care?
It means that they came back and Blue Cross couldn't identify what it was in the report.
Okay. All right. Because there's a lot of those and some of them are pretty big.
Yeah. It's usually they had a hospitalization and then there were significant costs outside after they got out of the hospital.
Okay,
But I
Thanks.
don't, it's their reporting and I don't know why. This is a frustration for us as well. Because it doesn't really mean anything and it doesn't help us work with it.
no, okay,
Any other
But our
questions?
our stop loss unit will be paying attention to all the large losses and we're monitoring the rheumatoid arthritis already. So we should know up, early if that's going to spike.
right,
And then we'll be working through that with the, like I said, this year, we're absolutely going to be doing a stop loss marketing. Some years we don't have to because we can negotiate this year we were able to negotiate a 0% rate change with
Yeah.
Blue Cross because those claims hadn't identified themselves yet. So we were able to lock in a really, really good deal with them early. This year might be a little harder.
yeah, we'll have to see what the year gives us, right?
Right. If in 6 months that person's not on the plan for whatever reason, or they're not looking at the same thing, quite frankly, I would expect the town to go down a little because I don't expect to see the same level of large losses.
Right,
The board's been right on, so there's no real spikes one way or another there. We're running right around the 92 to 95% range, which is pretty good. We don't want to get over 100 if we can help it,
yeah.
because then you're pulling money from reserves.
Yeah, did you notice if any of the town was because of delayed care, because the results were so good last year?
It could have been. We don't know for sure. I mean, delayed care is difficult to tell if it was a bigger claim because somebody chose not to go for treatment during COVID. And then it was identified later. We don't know if that actually drove a bigger number than it would have if they had gotten treatment right away. But we do know that people didn't go for a year.
Yeah, it may have just driven more utilization in the current year than last year, right? If they delayed knee surgery or whatever type of surgery,
Right.
it could have just shifted it, not necessarily made it more expensive.
Right. But you got about $800,000 in costs that were large losses that you didn't have previously. And some of that also, what might not have been a large loss, but you could also saw utilization increases in the under 50,000 range. But the bulk of it, typically your claims last year for the town, let's see, the previous year you spent 2.4 million. This year we spent 3.7 million. So it's about a $1.3 million increase. And about 700,000 of that was 5 people.
5 people.
Any other questions?
No other questions? Okay,
Okay, thanks everybody.
thank you.
Thank you, everyone.
Thank you, everyone.
So next is USB.
All right, so we'll get started. Thank you for having us. Hopefully next time we get to see everybody, but we'll go through the report. We kind of start out the most recent meetings by saying if you kind of feel unsettled every night when you go home or about to go to sleep, it's kind of normal right now. And that normally we'd be talking about one black swan event or some economic or political event that's hurting the markets, and we kind of try to figure out what's going on. Right now, arguably, we have 4 or 5 black swans or things affecting the market geopolitically and economically. We have everything from what's going on with Ukraine and Russia. We have inflation. We have interest rates moving up with the inflation. We have China with some dislocations within their own economy. They're having real estate problems. They're also having unemployment problems because part of what they did is to have a shutdown of their economy completely. And that's very unsettling. So there's 4 or 5 different things that everybody's dealing with and trying to understand. The other part of it that we relate is that while 68% of all Americans are living paycheck to paycheck right now, the 32% that are not living paycheck to paycheck still are flush with cash. Throw into that the private equity people, the venture capital people, the real estate people that still have borrowing power and lots of cash. And that's why we're not seeing the markets coming apart at this point. We've rebounded a little bit. So let's go through the markets a little bit right now, and please ask questions as we go through it because there's a lot going on. Okay. And what we're going to do is we're going to report. David, do you want to put the agenda up, or did we not send that along? So what we want to do is do the market overview. We'll go through the performance as we're supposed to through the end of the quarter, June, then the year to date, because a lot's changed since June 30th in the markets. We'll review the annual contributions that came in at the end of July that have been invested. It's our time to go through the investment policy statement. More importantly, between the last cycle and this one, there's been an actuarial change, a reset lower on the actuarial rate, which also means we'll discuss at the next meeting to do a new asset allocation study with new capital market assumptions with that new rate. So anything we're missing that we need to go through? Okay, so let's get it kicked off. David, why don't you kick off the market
Sure.
overview?
Yep. Thanks, everyone. So, what we've experienced this year has been slowing growth economically, but that's been off the back of a very extraordinary couple of years, obviously, where you had record economic contraction, 2020, and then a record rebound that was driven by stimulus. And so that transition from, a rapid growth to kind of a more normalized growth has caused some turbulence this year, and more specifically, it's been related to interest rates and inflation. And so, at the beginning of this year, the expectation of what the Federal Reserve was going to do is much different than what it is today. In fact, it changed very rapidly in late January through February, where it became apparent that inflation wasn't transitory or temporary, and the Fed needed to do more than what it had been communicated at that point. So very quickly, the bond market readjusted and did so in a historic fashion. So that what I have up now is the bond prices, is the dark brown, and the bond yields, the inverse of that, going back to 1991. And so, we all know that interest rates have gradually come down over the past decades, and then bond prices therefore have gone up. The red on this shows any period of time that the bond market was down 5%. So it gives you an idea that historically speaking, there really hasn't been much turbulence in the bond market, and now we're seeing top right, the red that we've experienced. Generally, overall bond market's down 10% or so. You could see how kind of unprecedented that is, and that's why a diversified portfolio of stocks and bonds, or even other investments, felt more painful this time around, because you did not have that ballast in the portfolio to hold up during stressful times. So the big question that the market had and still has is, what is the Fed going to do, and how much of monetary policy intervention is too much, and can the Fed thread the needle? And so they have a very tricky job where they need to slow the economy to the extent inflation comes down, but not do it to an extent where it drives us into a recession. And back in July, I'll try one more time. Back in June, the expectations that the Fed was going to pull it off was very, very low. There's very high pessimism in the market, almost probably to the extent where it was too negative. And so what we've seen in July and August is that the recent CPI inflation read trended in the right direction. Now it's only 1 month, but because that number wasn't terrible, you had a strong rebound in the market. So it just goes to show that we're in a very tricky period, not just the Federal Reserve, but as investors. Long-term fundamentals we think are okay. There's definitely challenges in the market, but our expectation from now until the end of the year is more volatility. We'll take the rally in the market, but at this point, we're pretty much past our central scenario to year end. And we'll go through that in a sec. Ashley or Mark, feel free to add anything that I didn't touch on.
Yeah, and there's a lot of debate out there as to recession, no recession. Did we technically have a recession because we had 2 quarters of negative growth? Is there more to calculating whether we're in a recession? I would say that argument has less importance than where do we go from here and what happens with inflation. So the market has favorably received some of the recent reports that suggested inflation may have peaked and is coming down. But given the increase in values we've seen over the last month, the rebound that we've seen, we've gone from a point where I think there's a lot of pessimism in the market to now there's more expectation that this proverbial soft landing is more possible. And the fundamentals, obviously that's a positive, but when we look at valuations today, they're still somewhat demanding. This is a somewhat older chart. If you look at the valuations on the S&P here, we're roughly around 16 times projected forward earnings. This is as of the end of June. If we look today, we're about 18 times projected earnings, given that we've had a nice rebound in there. And so, query whether or not the earnings and the price earnings ratio is realistic if we continue to slow and margins continue to be pressured. So we're starting out at a level that by historical standards, we're a little bit pricey right now. And we also don't know what the E and the PE ratio is going to look like. So, I would say we are cautious at this moment. I'm not suggesting that, we're going to have that hard landing by any means, but, it is helpful, I think, to step back and take a look as to, what the market is pricing in, what risks are being priced in and what risks are not being paid attention to. And right now, I'd say that the sentiment is much improved, but valuations are much more aggressive.
So the only other thing I would throw in to what Ashley and David just said is that inflation potentially has peaked, but that doesn't mean it's going to go down at this point. So certain industries, we know that we have shifted from consumer goods where the inflation has hit the hardest to other sectors right now. But the inflation of wages is not going to come down. Rents are not going to come down immediately. That's going to take time if things do slow down. Right now, wages will stay up because if people need to get a job, they can get one. They may not like what they're going to be doing, but they can earn a good living because there's plenty of jobs around. The other part of inflation that's not going to come down, and I'll use it because we're in the town of Newington, when we talk to other municipalities, I can say and Janet, you can correct me if I'm wrong, but a fire hydrant 3 years ago cost about $2,000. And now if you can get a fire hydrant, it runs up to $10,000. So that type of inflation is not going to go away. The transformers that are on the utility poles were $5,000. And again, if you can get them, they're $20,000. That is not going to come down so quickly. So the inflation that we have is still going to be around. And if you look at the journal today, you'll see that there's a big push between companies like Walmart and Target and the vendors that supply them as to who's going to absorb the costs of all the new commodity prices and wages that are hitting. So the inflation is not coming down dramatically right now. It just looks like it's stabilizing for now. Does that make sense? Any questions on that? Okay. So go on, David, I'm sorry.
Yeah, so up on the screen is the projection to year end. If you just focus on the top row, July 1st, the S&P was at 3781, and today it's at like 4250 or so. So it very quick rally. Oops, I switch screens here. Did I just close it? Apologize. Let me open up that attachment again. So I'll go from memory here. The 3900 is our base case.
David, you want to try putting that up again, or?
Yeah, I'm working on it. Well,
okay, hold on.
So the 3900 is our central scenario, which is calling for moderating inflation in the second half of the year. The downside top right here, that's a scenario where inflation doesn't come down, but it's also a scenario where, Europe goes into recession, the war in Ukraine doesn't let up, and supply chain and commodity costs still remain an issue worldwide throughout the rest of this year. And so these numbers are very quickly stale because of the rally. So we're talking about being at 4,200 or higher, which means that from now until the year end, again, this central scenario, we're already beyond it. So that's why we're saying, we'll take a bounce back in the markets, but just recognizing what Ashley said, valuations likely have gotten a little bit ahead of themselves. Long term, obviously, we're still believers in equity, but in the short term, we think there could be, the market could take a breather here. Any questions? Okay. We could transition to the portfolios, and starting with the police pension.
Sorry, David, just one question. Last time you guys said that you thought it was going to be between the central and the downside, I guess.
Yeah.
Now, are you thinking it's going to be closer to the central because of the big bounce so far, or are you still at the same spot?
I would say that's fair.
Yeah, we're closer. We're closer to the central now, John, than we were before, given what's going on with interest rates and the way the yield curve looks. Yes.
And we've had one data point since then that points us in the central direction, and that's moderating inflation. But again, it's one month.
Right. Okay. Thanks.
Sure. So the
only thing, David, I want to point out before we start going through the portfolio, one of the things that we've been very cautious with when looking at the metrics of the portfolios, both on the equity and the bond side, is looking at the companies that the managers hold or the fixed income to make sure the balance sheets are not over leveraged and that their debt is in control if they have it, or flush with cash. So we're watching for potential problems with balance sheets that are leveraged up, and we don't have those in the portfolio. Okay. I'm sorry, David.
Yep. No. So this is the target versus the actual allocation. In this particular screen, we're looking at the police pension, but really through June 30th, there was a slight underweight to fixed income, about 3%, and then a slight overweight to equity. Specifically, the large cap, the U.S. section of the stock portfolio has the overweight, and international has an underweight. Okay. So just some positioning in the portfolio.
David, that's also gotten, because of the rally, that's also gotten more overweighted in the equities, right? So that was June 30th, right?
That's correct. Yep.
Correct.
Yeah, if you look over the last month or so, U.S. stocks have significantly outperformed non-U.S. stocks as the dollar continues to be strong. Where we have seen a bounce back, though, has been in small cap stocks. So small cap stocks relative to large cap have actually been strong. So that's changed a little bit there. But yeah, you're right in the sense that that imbalance has actually increased as the U.S. stock market has done a little bit better.
So the fiscal year end performance and the calendar June 30 performance is on this page. So fiscal year was the full year minus 14.23. And then we'll show you in a second, just in July through August, how that's made up some ground, but for fiscal year purposes, this is the report. We also at the last meeting approved several changes in this portfolio. So that's all reflected here. Partly that's why you see a lot of numbers in the net cash flow column. So just to recap, we replaced ClearBridge Large Growth with the Vanguard Growth Index. Now there is some residual, from dividend payments that come into the account. That'll be cleared out at the next meeting. We replaced Euro Pacific Growth Fund of America with the Vanguard Total International Stock Index. That was being proactive. Long term, that fund actually has done well, but shifting away from growth to the index was a recommendation. We trimmed from Western, so reduced the risk within the bonds, moved it to the shorter term bond funds. And then lastly, which actually you can't see on here, it was taken off. Oakmark was the international manager as well. We took those proceeds and moved them to the US value side, and MFS value. That was done across all the portfolios, including the Opeb. Also, just Mark had mentioned the end of July, the annual required contributions came in, and so they've been invested. So you don't see that here, the 6/30 report, but that did come in. And so just some more recent performance this was alluding to. So from 6/30, I'll make it a little bigger, from 6/30 to August 10th, the portfolio was up 7.21, and if you want to work on a calendar year to date, that's down 11.33.
Any questions on that? I'm sorry, David.
No, same question.
Anybody have any questions?
Hi, Richard here. When did you
Yeah.
guys switch over to? When did you guys buy into VTI?
Mid-June.
Oh, okay. Let me see. Not I mean, because they were definitely underperforming for quite a bit, but they I'm looking at the rebound here. That's pretty good timing.
Yeah, and also just to
At 181.67 on June 16th.
so there's two things here. So we actually did so VTI, we have the Vanguard. So that was the total international stock index that we went into. I don't know if that's because VTI, I believe, is US, right?
That's right.
So we have the Vanguard 500, which is that wasn't touched. That's been in the portfolio. That would, I guess, be not exactly VTI, but close.
Okay.
So there's been a few different things. So, but at the last meeting, we took the ClearBridge Growth Active Manager, put it into the Vanguard Growth Index, and then on the international side, we introduced this fund. Does that help?
And to what you said, Richard, it was invested 6/17, which is pretty close to the date you said it bottomed out, right?
Yeah. Well, the bottom. Yeah, that was pretty close. Good call, gentlemen.
David is very lucky that way. So
Timing is everything.
Yep.
Yeah, and also, I mean, we had been talking about at that point, just sentiment being pretty poor, and that anytime you have those type of extreme environments, sometimes you're poised for a bounce back. We have been saying it, and then we got one. So, and now we're saying, okay, let's tamper our expectations a little bit. But that's why staying invested is very difficult to time these things. Okay, so let me just move on. We won't go into all the portfolios are very similar, so we'll just give you a high level view. This is I believe the municipal pension. It is, okay.
Yep.
So again, fiscal year, very similar. Same changes were implemented. So also it's worth mentioning, we talk about managers on watch and all that. We just made a handful of changes, and there's nothing that, nothing remaining in the new updated portfolio that we would want to change. We're very comfortable with all the underlying pieces.
Yeah, and you may see one thing I'll mention regarding the manager lineup. You may see a number of fixed income managers there, and they generally have complementary styles.
If you want to put the managers up,
Yeah.
fixed income. So
Yeah, so if you look under the fixed income category, you'll see Bradford, Marzick, Core Plus, and Western Core Plus. We did lower the exposure to Western because you'll have more non-investment grade debt and corporate debt there, the area of the bond market that's subject to the most volatility if the economy is weakening. So we did lower the exposure there. But both Bradford and Western, they'll typically be somewhere around where the overall bond market is in terms of the average maturity of bonds. in those portfolios. So you may have a duration of 6 to 7 years between those two, but we complement them with 3 other managers, BlackRock, JP Morgan, and Templeton right now, that have quite a bit of underweight on duration relative to the broad indexes. So overall, when we combine them, I would say that you're underweight the typical bond portfolio in terms of average maturity. And the rationale there is, we don't want to declare victory yet on inflation. The Fed has said that they're likely to continue to raise rates. We'll see what ends up happening. But if inflation continues to be stubbornly high, if the job market continues to be, extremely tight, and the Fed has to go even further than what the market anticipates, then long-term bond portfolios are going to struggle. And so we wanted to be a little bit more conservative on the bond side. But when we put these portfolios together, we do reflect our market views, and we do try to have an average exposure that reflects where we think we are in the business cycle and where we think interest rates are going. On the equity side, again, we do have, fairly nice diversification into market caps, geographies, and investment styles. So we'll have most of the monies in the U.S. market. We do have some in international managers. We do have some small and mid cap exposure, mainly through your Kane Anderson, small core positioning. And then we have a mix between growth and value. But, if you add up the percentages, you will find that we do have a slight value bias in the portfolio. And the value part of the market, because of the type of sector exposures you have, because of the type of companies which tend to be more blue chip oriented, more dividend focused, we think that they have a little bit of a higher quality bias, and also would hold up better if we continue to see inflation become stubborn. So you'll see a consistent theme in what we do. We never going to go too far in one direction, but we try to reflect our market views in terms of the allocations of the managers that we select.
So the only other thing I'd throw in on this sheet is on the fixed income side, the returns, which are negative double digits, hasn't been seen in, well, I guess we saw it briefly in 2008 when stocks and bonds moved the same way down. But this type of move down in the bonds, it hasn't happened in 40 to 50 years. And we expect the Fed to raise rates at least 2 more times, between 100 and 150 basis points before the end of the year. That's what we anticipate at this point. A lot of that should be in this bond market performance year to date, but we'll see how it goes after that with the inflation and what the Fed is willing to do. Okay. Whereas I've been telling people, when I started in this business, I could get 10% on a CD and a set of glasses, and my mortgage was 13 5/8% floating. So this doesn't look that high to somebody that's been in this business as long as I have, but companies are used to operating at near zero for cash flow, and municipalities, the funding has been much lower, but this is a dose of reality in terms of the rates moving up for the first time in about 20 years. So.
All right, you got ripped off. I got a toaster instead of a set of glasses. In my
Yours lasted longer.
All right, so the administration plan, again, just going to show you for the purposes of seeing quarter end value, but everything else is the same. And then for, through August 10th, you see a similar rebound. The Opeb, just as a kind of quick refresher, there is an annual contribution that comes into the Opeb, and then the majority, not all, but a large portion of that throughout the year goes.
Hey, do you want to put that page on? Yeah. So.
Which. Okay. Yeah. So here the Opeb's allocation changes throughout the year because in the beginning of your fiscal year it's more conservative, which if we fast forwarded to today and showed you the allocation today, it would be more conservative. And then by the end of the year, the allocation looks closer to each of the pensions because each quarter, Janet, uses the short-term funds in the Opeb, the more conservative funds, to pay out claims. And towards the end of the year, it's essentially that short term has been fully depleted. And so the longer term bucket, the growth part bucket of the OPEB looks similar to the pension, which is what you're seeing on this page. It's not exact, but it's pretty close to the pension allocation with that, 65-35 or so within fixed income.
So I just want to throw in, Kate, for the newer members, and if you know this already, please shut me down, but this OPEB is set up as what I would call a pass-through trust, correct, Janet? So it gets funded at the beginning of each year, and then the risk management between Janet's group and Lockton manage the risk in the portfolio, what's being paid out. So it's about risk management and instead of insurance premiums with a stop loss insurance on it. And at the end of the year, after that management of the risk management, whatever's left over is retained in the OPEB. This was started not that long ago, and you can see the residual that's in there is $9 million at this point, approaching 10. And that is building up over time to offset the OPEB going forward, or the funding of it. And it's worked out very well at this point. When we first started, it was all in cash and CDs. Now, as you can see, we actually are able to take risk in the stock market and the bond markets. So it's worked well.
Mm-hmm.
Any questions on that?
So same changes that occurred as far as the manager level occurred in the OPEB as well. So that, again, that longer term bucket serves mainly as the way this grows. The short term bucket is either cash or it's one of these two funds, JP Morgan or BlackRock Strategic Income. So right now, fast forward to today, these two funds have a higher allocation, bringing the overall pool to be more conservative than what it was on 6/30.
Okay.
May I ask a question?
Sure.
Sure.
How much, I mean, this is way above my understanding, so I'm not going to pretend I can even grasp a lot of this. But in terms of my responsibility as a town councilor, the information that you're providing right now, how much of this is informational? Because I'm kind of still sort of new at this, and how much of this is going to inform any decisions we make in the next budget cycle? Thanks.
So, Janet, do you want to do that first?
I'll grab that one.
Okay.
Mitch, the amount that goes into the budget that you have during the budget cycle, those are the numbers we get from the actuary. It is based on part on our results that we get from the market. Yep. And what they see from the census data on our participants. But directly, this is just one part of it that the actuaries give us
Okay.
the numbers based on.
Okay.
We just take what the actuary gives us, the number. We don't usually
I
adjust
don't
it.
question them. I can't figure out what they do anyways.
Right. We just take what they give us as it was the gospel.
Yes.
Okay. Okay.
Well,
Thank you.
Not all of us do, but.
Well, not all of us. Okay. With the exception
of. Just to give you a feel, the investments are down a lot. So that's not going to be a good thing. And when we get to counselors' comments, I've taken a look at the percent funding as of now, 6/30 versus last year. And I'll provide those numbers then, just to give you a feel, because, and we don't have the actuary's current analysis, but this is based on her analysis from last year and what she projected for the liability as of 6/30/2022.
Thank you very much. And I know, like most of us, our 401ks have been hammered. I just wanted to make sure that I'm paying attention to what I need to pay attention to the extent that it's going to inform any decision I make with Tim and my other colleagues. And if it isn't as relevant, that's fine. I just want to make sure I'm tuning into what's important for decision-making for the best of the town. That's all. But thank you.
Right. Yeah, it is relevant. It's just the fact that it's driven by what the actuary is going to tell you 4 or 5 months from now, just before the budget season.
Okay, thank you.
You're welcome.
So if there's no other questions on the portfolios, we can discuss the investment policy statements. So we wanted to put this as part of this meeting for two reasons it's a good exercise, even if you've seen this before, to just a refresher and have an open discussion about whether anything needs to be adjusted, but also for new members that have never seen this, it's very important. So we periodically will do this. Sometimes we'll have edits based off of just, changes in a variety of reasons, and that sometimes it's just a review.
So I'm going to say in here for Mitch, because you asked the other question, we at UBS are signed as fiduciaries on this plan, okay? So one of the guiding roadmaps I'd call is this investment policy. This will guide us into what we're supposed to do to start with. The due diligence on the managers and the reporting is all on us, but this is a good understanding of what the town is expecting in terms of how the funds are going to be run, the risk tolerances, the kind of reporting in broad strokes. So we do this at least every year, or in the case of an actuarial change or change in the policy itself, we'll do it inter-year, but at least once a year we're reviewing this so everybody on this committee and us understand exactly what our marching orders are. Okay.
Thank you.
Okay.
So this review, we really only had one update. And again, this is just, John had a lot of input the last time around to this policy, but essentially, what's changed since the last time this was written was the actuarial rate of return, which is later in the report, has been reduced. Janet, do you want to comment on just the change, just to bring everybody up to speed?
So yeah, if you've looked at the latest actuarial report that's up on the website, we did reduce the interest rate assumption. It went from 6.875 down to 6.25. We had originally been bringing it down 0.15 per year, but we were able to, with seeing the amounts that we're going to have to contribute stay steady this past year. They said, let's take a risk, let's bring it down, let's do a good jump down to more close to what we want our ending goal to be, just in case we see something down the road that doesn't pan out well. So that's why you did see a bigger jump than we had before. It gets us closer to our goal, I think, that we were trying to reach than we had been in the past. And that's the shift that you're seeing this past year when we made our contribution for 2022-23 fiscal year.
Thanks. And just one more on that. So at the next meeting, we would like to do an asset allocation study, which is where we project future returns. That's obviously it's a projections, but we do so over kind of a short-term period and a long-term period, and usually the long-term projections are more applicable to a pension actuarial rate. And what we can say is that our updated capital market assumptions are, especially because fixed income yields are now higher than they have been in the past few years, that accompanied with your lower actuarial rate, our expectation is that study is going to show that your current allocation will likely help get you to that rate. But that's what we plan on presenting to you at the next meeting. So we didn't plan on going through this word by word. Just I'll skim it and just give you the gist of what's in the policy, and then of course please stop me at any time. If you didn't get a chance to read through any of the policies and you want to, after the fact, let us know. Generally, the policy is the spirit of the way it's written. Sometimes, you'll see it done different ways. Our view is that you want the policy to be specific enough where it's useful and vague enough where it's not restrictive. Because if you say, you're going to do X, Y, and Z in a policy, and then that doesn't get, followed through on, it becomes counterproductive. Really, this is just a governing document for new and existing members to get up to speed. Defines roles and definitions. In this case, you have different parties. You have an investment management consultant, which in this case is UBS. You have investment managers, which if you think back to the report, all of those names that you saw on the list are the managers, custodian, co-trustee, if applicable, and then, more definitions. So the next section goes through the responsibilities of this committee. So that would be an important one for everyone to get up to speed on. But much of what you see is common language. Generally, you want to act in prudence, diligence, and oftentimes, really, if you're not an expert in an area, that's okay. That's why the next section, that's why you essentially hire investment managers or investment consultants to be a fiduciary alongside you, and that's what we are via contract. It doesn't relieve your fiduciary responsibility, but it helps you deliver on your fiduciary responsibilities. All right. Please stop me if if I'm skipping over something. So, in general, investment principles: minimize the risk of large losses. Cash is to be deployed productively at all times. Why would you put that there? Well, it's a long-term investment, and it can get tempting to move everything to cash when the markets look bad. And again, as a fiduciary, you want to think long-term and be a steward of the capital. And those large bets, or those, they may or may not play out. Here is where we updated the actuarial rate. Okay, so we have benchmarks for the portfolio, which you find in the report. So we're looking to meet or exceed the benchmark over time. Also, risk is another piece that plays a role into it. So you can beat a benchmark, but if you're taking significantly more risk to do so, then that's a factor that should be taken into account. Liquidity. This is important. So the way this is written, at least 90% of the assets need to be liquid. Right now, 100% of these assets are liquid, but if, for instance, this committee wanted to put money into private real estate, something along those lines, again, the threshold is at this point 10%. And we have other requirements here about more granularly. This is for us to so that certain more risky areas of the market don't become a large part of the portfolio. So like emerging market debt, for instance, this plan has very little, but it would be capped at 5% of the total. And then finally, this is the long-term target. And when we do the asset allocation study, this will kind of coincide with that. What's the long-term target of the policy? And then within that, you have ranges, minimums and maximums. So we had talked about right now, we have a slight overweight to the equity side. So the total equity is more like 63%, 64%. So that's within the ranges here, but it gives this committee flexibility to be able to shift within reason.
And I'm sorry, is fixed income, what instruments does that refer to, fixed income?
Bonds in general, and then there's all different types of bonds.
So in terms of bonds or fixed income, it's going to cover everything from U.S. Treasuries, corporate bonds, mortgage-backed securities, collateralized mortgage-backed securities. Anything that has a definitive maturity date and an interest rate is pretty much a fixed income.
And then is cash just in like a money market account, or is that not applicable here?
So cash is in from two places. The managers, whether they're stock or bonds, are going to carry some cash on their books from time to time. Probably around 2% would be the norm. That is part of their total return. So that's cash. Okay. And then we have cash set aside that we may be allocating to managers or getting ready to send out. That sits in money market. But that's both of those are considered cash.
Okay, thanks.
Okay.
And then the final here is just prohibited or allowed securities, just to memorialize what can and cannot be invested in the portfolio. So most of the funds are most of the types of investments are allowed, but this structure just allows for discussion as to whether or not something should or shouldn't be in the future at any point.
And there's a good outline of the fixed income securities right there, Mitch. Okay.
Okay, thank you.
Okay.
The OPEB is a similar policy, although the version we sent you had some blank spots. We have to update that. But the difference is that there's no actual rate of return for the OPEB in the policy. The long-term target is the same, but if you notice, there is this sentence or two right here that talks about a portion of the OPEB funds will be separately held and allocated into short-term liquid assets to meet distribution requirements based off of cash flow needs. So that's what we were going through earlier in the report, where you have this long-term portion, but then you also need to pay out claims. So we want that not to be put at risk, because the idea is, long-term, sure, but in any given quarter, if you put it in stocks and they're down 10%, and then you need to take out, you're pulling out in an opportune time. So generally long-term, similar to the pension, but you always have kind of a short-term bucket for liquidity purposes.
Especially like in the last year when we got hit with some big claims, it looks like, compared to the COVID, the pandemic time.
Yeah. There's two, it's, now at least we earn some interest on those short-term investments, but in the past it didn't matter. You still needed to keep it safe. So. All right. Any questions or comments or feedback on the policies?
Hi, David Johnson here. I had a question about the actuarial rate of return at 6.25. Could you just speak to that a little bit more and give us a better definition? Because I believe we haven't come close to that rate of return based upon a slide you showed earlier. So can we talk about, the goal there, and why are we using 6.25? And how are we going to get to that rate of return if we're not there now?
Yeah, thanks, Jason, or David, sorry.
Yeah.
Mark, do you want to go?
So yeah, I'm gonna start. So the actuarial assumption is for simple math, and John, correct me if it's not correct, but the actuary will take a look at the pool of people that are in the pension or entering the pension, and then look at it as one return, taking stocks and bonds or the capital markets assumptions of major firms and their own firm, and then coming up with a number of what we're likely to hit during that period. What's also taken into account doing that is what the town or the municipality can afford to pay. So it's a balancing act between budgeting what can go into the plan and then the rate of return that the actuary sees for that pool of employees. So historically, this plan had a higher number. Before we even came in, this had a much higher number, and the plan was underfunded. So when you're seeing the numbers and missing it, part of that has to do with the funding levels and what the town was putting in prior to all of us sitting here. So the likelihood of hitting that number got hurt this past 6 months. If we did this report at the end of last year, you'll see we beat the actuarial assumption that we had for, I think, the past almost 10 years. The down 14% through June hurt us this go round, and that's why they take a longer term view of it. David or Ashley, did I miss anything? And David,
yeah,
does that make sense?
And also, so David, the report, the page we focused on had a 5-year return, and then an inception return, which actually goes back to 1999, which were both in the 5s. But there's a later report, later page that says that the 10-year return on these pensions was 6.83, and the 15-year return, which includes the financial crisis, was 6.13. So like closer to that 6.25. So I think the idea over time was to move that assumption closer to the longer term rates of return, which if you look at the 10 and the 15-year, it's pretty close. And that's
David,
just in a different page.
Can you put that up on the screen? so
Yeah, yeah,
David can
sure.
see that?
Yeah, that's a good idea. Sorry.
David, does that help answer the question?
It does, but I'm
Your
guessing,
question-
I'm just wondering, it's still underfunded, right? Just in layman's terms?
Yes,
Okay.
severely underfunded. David, I'll give it another try too. I'll correct one thing Mark said. I agree with him. It's for budgeting purpose to try to fund a pension. I don't agree that the interest rate chosen should be balancing what the town can afford. Interest rate should be what we'll be able to achieve. And so we've had a lot of those discussions. Most of the towns, municipalities in Connecticut and countrywide used to use 8%, when the market was going gangbusters.
Right.
Bond rates were higher, bond rates are 4 or 5%, so people were using 8%. The actuary, every time they do their report, they actually look at long-term returns and pick what they think the answer should be. I think historically the actuaries come up with, I'm going to say low 6s for a rate of return. We haven't achieved that inception to date over the ups and downs in the market, and they've actually put more pressure on us to reduce the rate, from 8. And then we agreed, the town agreed a few years back that we take out 1/8 of a percentage point every year, 125 basis points every year. So we started doing that, and that's when we got down to 6.875, 6.825. And then they decided, because we weren't involved, the committee didn't meet last year. So it seems like they decided to go down more to 6.25. 3 or 4 years ago, I proposed that we should have the actuary do it at 6, just to see what the difference was. And I got outvoted because I was told the town can't afford it. I said, that isn't our place to decide what the town can afford. Our place is to try to get the right answer to the town management and town councilors, so they can decide on how much they can afford to fund. So it's an ongoing discussion. I feel more comfortable now that we're down to 6 1/4, but when the actuary comes in, and also UBS is going to give us their look at long-term rates, that's something the committee probably should talk about.
Okay.
Because we don't decide on interest rates. We decide on, the actuary makes a proposal, what she's going to use, and then the town council and town manager decide on what we're going to use for an interest rate. We can only give input.
So John, to blur this a little bit more, as interest rates move up, the actuarial's calculation is actually going to bring the liability down some. So there's another moving part in here, because that interest rate assumption becomes very important going forward. And we've been in a very low interest rate environment since we've been with the town.
Well, but it's a return rate, not just interest.
Yeah,
so.
right.
So
That's why. Oh, sorry, go ahead.
Sorry, I'm just going to add my 2 cents. This is Janet. Just so you know, I couldn't get the actuaries for this meeting because this is their very, very crazy busy time, but they will be at the next meeting. And I think there's a lot of moving parts to this besides just that rate of return that all goes into the report. And I think we need to have them explain the whole thing because it's a lot of moving parts going on. And yes, we are underfunded. You are correct, John, we are. But every year since I've been here in the last 5 years, that percentage that's been funded has increased. We haven't really gone down. So we might this year, depending on how the market looks when they finish.
We're definitely going down this year unless the actuary comes up with some wild ass assumptions.
And just remember too, that of the 3 pension plans we have, only one of them is still an open pension plan. The other 2 are closed.
Right.
Only the police one is still open.
When you talk about underfunded, what are we talking about numbers wise? How do we determine that? And what's the reference point?
The actuary determines it based on the liability that they do in the report every year and what assets we have in the fund. That
So
was
is
the
there an
20%.
industry standard, like a ratio that
You,
we're supposed
you
to be
want to
following?
be, you want to be at 100. We're not. We're not.
What are we at?
Well, just to give you a feel, I was going to mention these numbers later, but we can do them now. The police department was at 78% funded last fiscal year end, Mitch.
Yep.
And then now because of and again, like I said, I took what the actuary projected for the liability as of 6/30/22 and divided it into the current balance, the assets that they have here. That 78% has dropped to 65, should drop to 65% unless the actuary changes some assumptions in her projections.
Well, you have to remember the assumptions too. It might be higher, might be lower, depending on what salary we're now paying them, how many people we have in the pension fund, the age of all the employees, how many people have retired, and we have had a significant number of police officers retire this year. So every year they retire earlier is a higher liability for us. As I said, it's huge, the amount of different things move this one around.
Right, yeah, I'm just saying that based on her projection of the liability last year, it would have dropped that much. To give you a feeling, the municipal employees, the liability projected as of 6/30/22 is 54.3 million. Our assets are 26.5. So that's 49. If all the assumptions hold, that would be 49% funded now, was 61% funded last year. The administrative ones, the liability that the actuary projected for 6/30/22 was 13.3 million. Our assets now are 4.9, 37% funded. Last year was 46. So not great numbers, but and then for an industry standard, it's all over the place. Some towns, I say Connecticut, probably, and David and Mark, you probably see more than I do. But when I used to do comparisons, towns are anywhere from 40% funded to Bristol's 105. And Bristol's only 105 because all the extra money they got from ESPN, they put for pension funding.
I was going to say they had one long position called ESPN that funded it. Yeah.
Yeah, and so that really helped them. They put it out there. At one point in time, they were at 120% funded.
Correct. Yeah.
So is
typically, the current countrywide, or maybe let's talk about the municipalities. An actuary can give you more, but I think it usually runs at the state of Connecticut like 70% funded. I don't know what's going to happen this year. It's probably going to drop. Some cities have done something crazy, like West Hartford borrowed $300 million to fund their pension fund. So they borrowed $300 million worth of money using municipal bonds and put it into the market last summer. Maybe not a great move given what the market. And so eventually they got to pay those bonds back, right? So they think they got to the place where they're fully funded, but now they have 300 million someplace else on their balance sheet.
Right.
So from a peace of mind standpoint, I can imagine if you're 100% funded or more, like Bristol, then you've got everything covered. But realistically, when is all of that going to be called upon at any given point? In other words, is that why municipalities or the state of Connecticut get away with underfunding, because they know not every nickel is going to be called in at the same time? And so we do what we can when we can.
Well,
yeah, I think things are going to be paid out over 35 years, 40 years, and some of them are people that just started in a pension plan, 20-year-olds, so it may not get paid for 60 years.
Okay.
You have to remember too that the ones that are closed plans, like two of ours, have a more realistic end date.
Correct.
The police is just going to go on and on and on and on. Whereas our municipal and administrative, we will eventually see a light at the end of the tunnel on those.
Yeah.
You said that they're closed and they're not admitting any more people.
No more people. Yeah. Nobody, no new hires. I think it was from the mid 90s, if I remember right, on at least one of them, that they closed the pension plans, except for the police one, to any new hires.
Okay.
Yeah, I think that, the only concern I have is somebody's gonna have to pay for it eventually, right? And so
Yep.
current taxpayers aren't paying as much as they should for the promises they made, and you're gonna put it on future taxpayers. That's why I've sort of always been arguing. I remember talking to a finance manager like 4 prior to Janet and saying, I went to him and said, you're 65% funded. That was in 2001. I said, it's not enough. And he goes, well, you would want 100. It's like, why not? Why shouldn't we be 100% funded? Everybody uses the excuse that, sometime you got plenty of time to pay it, but somebody's gonna have to pay it. Sorry, I'll get off my soapbox now. Tim's heard it too many years already. Janice heard it just many.
Well, there's the concern that if you wait down the road to pay it, then you're using those, those dollars down the road that aren't worth as much now.
Mhm.
Right.
Am I getting that right?
Yeah.
So it would behoove us to try and get it 100% funded with today's dollars rather than tomorrow's dollars.
Yeah, but I think to be fair, we've always funded 100% of what the actuaries told us. And then one year we actually put in the town put in an extra 1.3 million or something.
Yeah.
So I guess the question, and I've had this question for the actuary several times, is, how come we're not getting there? And so, you'll all have to listen to what the actuary tells you and see if you feel comfortable with what she's telling you.
And we'll hear that at the next meeting.
Next meeting for her?
I'll
Okay.
try to get her for the next meeting, yes.
Okay, that'd be instructive. Very good. Okay, any other questions? Okay, move to remarks by committee members. Yep, good. Maybe you have a question? Miss? Remarks by committee members?
Sorry, aren't we gonna do the ordinance?
Oh, I'm sorry, you're right. I'm sorry.
That's okay.
I jumped right over C.
That was John's. This is John's. I sent out
Okay.
his stuff.
I'm sorry, John, just jump right over it.
Yeah, that's okay. Yeah, I don't know if you had a chance to look at it. The issue that I've always had with the ordinance is it's always pretty much focused on employee insurance and didn't really say anything about pensions. So, if you get a chance to look at it, all I've done is really split out. I've left the ordinance pretty much what it was for the employee insurance part of it, because it talks about, hiring an agent every 3 years to do the broking of our health insurance accounts, but it never really talked about what we did for pensions.
Okay.
When I had to get approval from my company 12, 14 years ago when I first got on this committee. And they looked at it and said, there's nothing in here about investments. How are you telling us the committee is responsible for investments? And I said, you're right. There's nothing in an ordinance about investments. So this whole first section is pretty much the same as the current ordinance, other than I've just taken out the pension piece of it and said, oh, so yeah, if we look at the employee pension benefits, the employee pension benefits is all new. Employee insurance is the same as it's been forever. But so eventually, I just think it's important that we have to put in what our functions are in the committee for the pension piece of it.
I agree.
So I think, we should all just read through the pension piece of it. We have a chance, and then decide if we agree that that's our functions. I think one thing I want to go back and look at is the statement that UBS went over, because I noticed some things in there that talked about what the committee's responsibilities are. I think I did this so long ago that I may have not considered that investment statement.
Well, you want to look that over, John, and meld that into this?
Yeah, I'll take another look at it, but I guess I'd like everybody's input if they look at the pension benefit piece of it and feel comfortable that, you know, those are our responsibilities.
Okay. Yeah, I think it should, you're right. It should spell out the pension part of it more than it does currently.
Yeah, it didn't have anything in it for pension, so this whole 8-38 functions totally new.
Yeah, then I recommend we should send this to the council for, you know, for
Well, let's put this on the next meeting for everybody's input, if they really
Okay.
get a chance to look at it.
okay.
And then we can go forward with it. That sound like a plan?
Yeah, and hope we can get a better
Yeah.
mix of people here.
And then let John maybe look at it we were just talking about to add that other section you just saw tonight and get a really
Right.
good document to send
Yeah,
to him.
let's, and then when you get it to John, send it back out and we'll look at it, the new revised version.
Sounds good.
Yeah, I'll take a look at it. The main thing I noticed that, you know, it says that we monitor and direct UBS. I think that's in here, but I haven't had a chance to go back and look at it, so I'll do
Okay.
that.
John, in your behalf, this was like 2 years ago. We originally were talking about the draft that we just sent out. So
Yeah, well, and I sent it to Ann before you, 3 years before that, so.
Yeah, right.
It's been more like 5 years.
it's old,
Yeah, so,
but it's good to start it going again.
yeah.
I think so. I think it is.
Yeah, I'll just compare the investment policy against this. I think it's covered, but I just want to double check.
Okay, good. Thank you, John. I appreciate your help. Okay, now our remarks by committee members. Anyone have any remarks? Seeing none, the next meeting. You want to pick one now, Janet, or you want to?
Usually
what
I
we get.
just, I'll ask again for Mondays. Do we want to do this? Usually we try to head towards the fall. I don't know if anybody wants to think like beginning of November. I don't want to go towards the end of November because that's usually holiday time where I start hitting people and nobody's available.
Right. So the November dates would be on a Monday, it'd be the 7th or the 14th.
Or we can push it all the way to the beginning of December if that's a little bit more time.
Well, I guess it depends on when we get the actuary. I think that's a key
All right,
component.
let me try, I'll get a contact with her and see which ones are better.
Okay,
And then we'll see if we'll try for the beginning of November or December.
okay, that sounds good. Because I think it's a critical, we had so many questions, it should be good to get her here to answer those questions.
Definitely.
And
Okay.
Shannon, when does she usually finish, give you a preliminary indication, like January or something?
It's like January.
Okay.
So she can, but we've just sent to her all our census data and
Yeah.
all our returns as of June 30th. So she has those. This is a little bit earlier than usually that we get them to her. So maybe we'll get those results earlier. I don't know.
Yeah.
I can't.
Yeah.
It can't hurt.
No.
Yeah, and maybe when you talk to her too, can you just tell her that we have several new committee members? So,
Yep.
you know, some of her presentations in the past, she's compared us against other municipalities that they do. So I think she does like 60 out of the 169 in the state of Connecticut. So I think she has some pretty good data on what percentage are funded, what they're using
Yep.
for investment returns, all that stuff. So I think that'd be really good for the new
Yep,
committee
yep.
members.
Definitely.
Okay. Okay, then we're to the point of adjournment.
Need a motion to adjourn.
I have a motion to adjourn.
I'll second it.
Anyone?
Who
All
gave the
those in favor?
first?
No, somebody who made the motion first.
I'll move.
Okay, now we need a second.
I'll second.
Okay, now all those in favor say aye.
Aye.
Okay, we are adjourned at 6:43. And again, sorry for the delay getting the meeting started, but hopefully we'll do better next time getting everybody here on time.
Thank you, everyone.
Thanks.
Thank you.
Thank you.
Bye.
Good night.
Have a good rest of the summer. Bye now.
Yes.
Bye-bye.